for us, one thing we don't compromise on is why are the founders doing this? If we find a company can have the best metrics in the world, to your point, but if we find the founder, motivation for starting the company is sell it within 3 years, that's a complete deal breaker. And we have never and will never invest in a seed company where, there's a short-term exit horizon. The reason why is because we are in it for those very large outcomes.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast, and today we have Giuseppe Stuto with us. Giuseppe is a managing partner at 186 Ventures, a pre-seed and seed stage VC fund investing across consumer, enterprise, and disruptive tech. In this episode, we talk about what they're building at 186 Ventures, Giuseppe's successful exit as a founder, how founders should evaluate acquisition offers, tips for building through the downturn, contrarian investments they have made at 186 Ventures, his biggest learning investing over the years, and so much more. So without wasting any time, let's dive straight in. Hey, Giuseppe. So good to have you on the VC 10X podcast. How are you doing?
I'm doing great, Prashant. Thank you for having me.
Yeah, it's a pleasure having you here with me today. And to start things off, can we first have your story and how you started investing?
Yeah, sure. So my story starts, at least my technology world journey started all the way back when I was an undergrad here in Boston, which is where our firm is based in the U.S. I taught myself how to program at a young age, and then just started to work on various web and mobile projects going into my graduation. So now we're going into 2011. And then shortly after my undergrad is when I founded my first software company. So we built FAM, which is a multi-party video infrastructure company, but that had a consumer-facing component that effectively brought group FaceTime to the world for the first time on the iOS before it was natively supported by any of the smartphone operating systems or devices. We built that user base to about 7 million active users before we sold the company to DraftKings in Q2 of 2018. And there I served roles on the product and strategy teams leading up to the IPO. And I would say that during my time at DraftKings is where my good friend and I, we started to angel invest together in early 2019. And the thought process was very simple. We had an organic inbound of very high quality technology entrepreneurs that were coming to us for advice and that were being referred to us for advice. So we kind of just said, instead of just advising these companies, why don't we invest in them? So we started to write personal checks under the brand of 186 Ventures. Fast forward a few years, I left DraftKings from a full-time basis, and then went to one of our early angel portfolio companies as their chief operating officer. And during this time, we continued to angel invest. And then come summer of 2021, after about 32 technology angel investments, we decided to institutionalize our investment platform. So 186 Ventures raised its first fund in fall of 2021. Today, we're a $37 million pre-seed seed fund, investing fairly agnostically across software, although there are a handful of themes that we spend more time on than others at any given point.
Right, absolutely. That's a great story. And I'd like to learn, what's the thinking and the rationale behind the name 186 Ventures?
Sure. So 186,000 miles per second is the constant rate of light. And we chose that. One thing, it is a cliche for sure. And I would argue that most VC firms probably named themselves just in a needing a unique name, which is kind of what we were looking for. You wouldn't believe how many different names or words are already used to label VC firms. But for us, it's really true to our mission and purpose. We genuinely believe that we move faster than most, not just in terms of making a decision, but in everything we do. When we tell a founder that we're going to help them get in touch with, let's say, regional banks, we'll do it probably within 48 hours, right? And I think it's really important to be able to do that in a market that's so saturated with many great VCs, on a relative basis, it's important to stand out. So we try to do that by, behaving at the speed of light in everything we do.
That's great. And like the market for VC names is certainly a very competitive one. Because hosting this podcast, I know that I've hosted multiple guests with the same first name of their VC firm. Like they have the same first name of the VC firm, and right,
Oh, wow.
and one of them has ventures ahead of them, and another one is capital, and maybe someone is capital partners. So it's like definitely very competitive out there. Uh,
For sure.
uh, yeah, and so you talked about like you were a founder yourself before, right?
Yes.
And you have had, I believe, a successful exit right there. So can you like walk us through that journey of having a startup and then getting a successful exit? If you look at it in hindsight, what factors do you think contributed most in like having that successful
Sure.
outcome?
Sure. Well, the bottom line up front, and this is irrespective of industry, it's building something of value, whether it be the technology itself, the product, the relationship with customers, the user base, in some cases, the actual know how, depending on what type of technology you're building. So, I think that it's always a combination of those things. And then depending on the investment thesis on behalf of the acquiring company, it may vary, right? It may index more in the technology or the customers that startup may have captured and has a relationship with, and so on. For us, I mean, it was not a very straightforward journey at all, which is, how it is for most startups. When we first started the company, we were building um, a basic web application that helped younger audiences, particularly high school students, share high school sports student news. And then we found that was an effective way to spin up micro communities of high school students, and then thereafter college students, leveraging Twitter's network graph. And we built a web wrapper around that. And then what we found I think we built up an audience of about 500,000 high school students, and we built up a brand ambassador base of about, if memory serves correct, 11,000 high school students, or 22,000 high school students across 11,000 of the nation's high schools. So we're at about 1/3 of the United States' high schools, which is pretty good penetration, especially in we're talking 2014, 2015. What we found, though, from a product standpoint, was that most of our users wanted to share graphics information, so graphical information, so image based. Then we found video based. Then we created a synchronous video broadcasting application. And we found that most of our users were actually just hanging out with each other. So we decided to it was mainly my co-founder's idea, was bring a standalone product that would allow these students, or these users, excuse me, young users, to be able to just hang out with each other in a group FaceTime setting, a private one. So it was a very windy journey. In terms of, why, we were approached by various suitors throughout the journey. Most of them were consumer companies. There were a couple of companies that were B2B because they found just the technology itself to be particularly interesting for their use case. But we were approached by many consumer companies that wanted to leverage group video technology for their experience, whether it be for their paid products or whether it be to stand up a standalone, video and media experience. And I would say DraftKings, fit that bucket, which is the company that acquired us. And there were a few others, but I think it was, a combination of the technology, the people know-how, and so on.
Right, absolutely. And when you are like approached by these potential acquirers, you as a founder, what are you thinking about at that time? Because it's always lucrative that there is an offer for acquisition from a potential company.
Sure.
So how are you like evaluating whether to take that offer or like keep pushing, like keep being
Yeah.
on that journey, and then like selling when the right acquirer comes, right?
Yeah, for sure. There's many inputs that go into that. I think specific to us, what was going through my mind was, I think, what do we think the longevity of the company and user base is? How is the team doing? Right? I'm only one team member, but obviously there's a lot of motivations, a lot of um, personalities around the table, and kind of where everyone is in their respective lives, because we were at it for 5 years, right? And I would argue some of the best companies and startups take 10 plus years to build, but 5 years is a pretty long time when you're really grinding it out every single week. And so, what was going through my mind was, how are we feeling about things mentally, right? We were still very, very bullish. And as, following 2018, you saw how group video continued to be such an important technology, especially during the pandemic. And I would say now, if we pull the conversation more high level, because I think it'll be very useful too for kind of people from various industries, it's really trying to be practical with where your goals are as founders, not even just your own personal goals, but goals related to why you started to build the business relative to the milestones that are effectively illustrate success criteria for you as a founder and as a business owner. Because at the end of the day, we're talking, we call them startups, but they are businesses we're talking about. Businesses are assets that generate revenue for various stakeholders, whether it be, their own employees, whether it be for customers, whatever, right? And shareholders themselves. And so you have to think, all right, how do I maximize shareholder value? And that's really the most important question, because ultimately, even as a shareholder of your own business, you do have a fiduciary duty to think in that lens. And so you have to think about, do you think you can compete? Do you think you have a lot of longevity? Those are, I would say, the objective variables. Subjective variables are, what do you want to do as people, right? If the entire team is burnt out, well, then you probably should think about moving on, because it won't end well for the business after some point, a period of time. But it's a combination of things.
Yeah, absolutely. Great insights there. And now let's try to shift focus on 186 Ventures, the thing that you're doing now. So what's your focus at 186 Ventures? Can you walk us through your investment thesis?
Sure. So we're a pre-seed seed fund. We write on average $250,000 to $1.5 million in our initial checks. We invest in software, and we're more stage focused than any particular industry. Areas, though, where we spend most of our time include embedded financial infrastructure, developer tooling, AI-enabled automation at the application layer, not so much at the infrastructure layer. Your typical vertical B2B SaaS, and then we opportunistically will spend time on consumer-focused applications. But the enterprise and AI component really touches on so many different industries, like property, technology, and so on. That's our focus pretty much.
Yeah, that's great. And while you're evaluating these deals, are you trying to look for yourself in the founders that are pitching you?
So we typically, it's a good question. It depends on the industry, of course, because depending on the industry, we believe you want to weigh certain things more than others, right? So if you're, like, for example, if you're bringing a financial infrastructure or a financial services infrastructure company to the market, you probably want to index on, well, who is doing this, because there's a lot of risk and regulatory know-how required, and it's one of those industries where bringing some level of qualified subject matter expertise is quite important. But I think in general, there's four pillars we like to look at. The first being the team, subject matter expertise, and so on, their motivations as human beings for why they're doing it. Second is the market, given how early we come in, and just given the model of our fund being a venture model. We need to know that the market can be big enough if there's a winner on our hands. So we like to look at the total addressable market and whether it's big enough to fit our investment criteria. Then the business model, one thing that we pride ourselves on early on, we think about, how is the team and how is the product, if there is a product, approaching and set up to build something sustainable. And what I mean by that is unit economics. Now, by no means am I saying that I don't think we've ever invested, maybe one company of the 19 or 18 that we've done so far in Fund One has had profit, right? But it is important to understand that it is viable one day to have profit, especially in today's market. So we look at unit economics and just the general business model and how the team's thinking about it. And lastly, the landscape. We invest in companies that are going into what's typically called a red ocean, right? Where it's so saturated with competitors. But then we also invest sometimes in blue ocean markets where there's very little to no competitors. And it all depends, right? I think it could be a good and a bad thing depending on the approach. But those are the four pillars at which we assess pretty much any of the companies that come our way.
Yeah, that's great. Thanks for sharing that. And now, like as we know, like we are all in a downturn as per like even the venture capital industry is concerned, and so we can say that these are not like very easy times for a startup to operate. Like there are difficulties. You need to take care of your runway, right, and all those things. So I know that you have a blog post on the topic how to build a company through a downturn, right? So can you like give us some insights from that blog post or on your own, right? What would be your advice for founders how to navigate the downturn that we're in right now?
Sure. I would say, there's so many different things and learnings, even from that article that you referenced and more. But I think, some of the big things is keep it simple, right? In a downturn, focus is very important. And you need to really force yourself, as much as you like to think that there's a lot of different goals that you need to focus on. There's usually one or two things in a good and bad market. There's only one or two things that really matter to the business you're building. And it's very important to make that clear to yourself and to your team members in a downturn because noise can be a killer. Resource management is definitely important. I think even from experience, you gotta make sure you cut deep once, not multiple times. There's so many companies that over the course of, let's say 12 months, they cut multiple times versus just one time. And if you think about it, and as a founder and executive, you need to think in this way. What does the end result look like? If you know the end result looks like where you need to cut your burn to X, you should just take the path of least resistance and least friction to that. So just do it right away. But ultimately, we as founders, and I've been guilty of this in the past, you'll always find ways to convince yourself why you shouldn't cut all at once. But boy, I can't think of one example where in hindsight someone has said, wow, I'm happy I did it in multiple cuts versus one. So those are like probably the two. And then the third is financing. Just don't underestimate the difficulty of the market and close money. I think there's a time and a place to optimize for valuation and dilution. Downturn is not. And if you think about it, speed is your best friend as a founder. And so speed to just getting your team the resources they need, speed to making sure you're financially sound is incredibly important. And, you may not get the best terms in a downturn, but if you believe your company is going to make it long term, you're going to probably do a financing when the market is great again. And then you'll be able to offset any of the, whether it be tangible or even just metaphorical dilution you feel like you took as a founder. Those are the biggest things I would probably home in on.
Yeah, absolutely. That's great advice right there. And let's talk about the differentiating factor. So, like we discussed earlier in the episode, there are so many VC firms out there. So,
Sure.
how does 186 Ventures differentiate and stand apart from the other VC firms out there?
Sure. So it's a combination of things. I think some of the things I want to talk about in silos are also differentiating, but I would say almost inarguably the combination of these things, if you really take the time to get to know us beyond what I'm just about to explain, are truly differentiating. One, we've been there as founders and operators of high growth tech businesses. So we are literally, former founders and people on the other side of the table who have talking to us. So that, by definition, brings a certain level of empathy that people who have not been in our shoes just cannot bring, particularly at the early stage. Then I would say our focus on seed. We don't do anything but seed. So all we think about is seed. And what that means is the phase from incorporation, from when you're seeing the Delaware or whatever state you're filing your incorporation in, all the way to generating $1 million in revenue, maybe $2 million in revenue. That is all we think about. Now, of course, we, at times we'll think about, well, how's the macro doing? How are Series A investors thinking about things? But in terms of our bread and butter and where we focus most of our attention is on that phase. And that is particularly important, especially as a founder when you're choosing to partner with a VC, especially if you're going to have a lead VC. It's important to understand, what drives them as an investor and a partner, and what do they think about. And the odds are that you're probably going to get more precise advice if it's just someone who thinks about seed. Not always, but I would say it's the case many times. Then it's just the way that we also have institutionalized, and a keyword, institutionalized various support mechanics. Now, I think there's plenty of great seed VCs, smaller than us, maybe bigger than us, that do a good job, in many different ways, providing value. But the key is providing consistent value as your portfolio grows. And not every firm can say, in my opinion, from what I've observed, on both sides, as a founder and now on the VC side, seeing how the sausage is made, can say that they really have a consistent way of adding value in different ways, right? So what does this mean for us? We have various systems and processes in place for how we can be proactive with what we call indirect value add. And I think I wrote about this too. So there's another article everyone should check out, which is how 186 differentiates, and some, if not all of what I'm saying here can be found there in a more elaborate way. But we basically, for example, are very effective at helping our founders drum up, follow-on financing interest, and not, we're talking sizable follow-on financing interest from Series A players at some of the best firms. And we do this because as a founder, most of your time should probably, not always, but probably be spent with your team and customers because you're building a business. So we as VCs, we have all these networks, access to capital networks at the Series A, B, and C. Why not put it to work? And we do that. So we have a process where we routinely keep our what we call downstream investors, so people who invest at the Series A stage and beyond, apprised of our portfolio and what companies they should keep in touch with. And then we do it as a way of gathering data points on how they think about seed companies in a particular industry. And then that in turn enables us to give our founders informed advice, not just opinion, right? And that ends up being pretty differentiated. And there's a couple of success stories already in our portfolio. And we're able to do it consistently. Whether we have 10, 20, or 50 portfolio companies, the process is designed to be able to continue with a certain amount of bandwidth put in, which we are able to sustain. So I would say, and we have many examples of other systems that we've institutionalized internally in a way that is a flywheel, regardless of the number of portfolio companies that we're able, that we invest in.
Yeah, absolutely. That's great value add all in all, and a great differentiating factor. And now let's talk about portfolio construction, right? So how do you think about having the right components in place for the portfolio and managing risk within the portfolio?
Sure. So, I mean, for us, we try to keep it quite simple. I mean, we certainly do have ownership aspirations if it is in the best interest of the company, and we feel like we have a certain level of subject matter expertise in that area. We think it is aligned for us to, let's say, own 5% of a business or more. But that not always has to be the case. But that's one mechanism for how we approach portfolio construction and manage risk, right? Because there is the opportunity cost risk, which if you don't own enough of a company and the market is not big enough, then you really, even in a successful outcome, you may not achieve the returns that you deem, required to satisfy, why your LPs are investing in you. And then, other mechanisms is staying within the range of our initial check sizes, which is $250,000 to $1.5 million. We very rarely will invest outside of that range. And that's a way for us to make sure we're building an even portfolio across 25 to 30 companies. That's the other point, is we aim for 25 to 30 companies, which we believe will require enough concentration to generate returns in our winners. But then also for us to make sure that we don't have too much risk in any one given company. And then we have a 70-30-ish split, where, a certain amount of our portfolio or our fund is reserved for the initial check. And then in a few of our winners, and we try to make it clear to our companies that we don't have a large enough fund to invest in all of our winners and the follow-on rounds, but in a few of our winners, we do have some reserves where we can invest in the follow-on. So I would say all of those items, and then of course a lot of the controls we have in place, such as portfolio reviews and making sure that we're just on a quarterly basis, if not more frequent, thinking about, okay, are we building out this portfolio in a responsible way? And the last and probably the most important point, honestly, is time, and cadence. So, for example, we we build in our portfolio over a 36-month period of time. And we do that because we don't want too much concentration in any one given vintage. So we launched in fall of 2021. Imagine if we deployed half of, which we did not do, but imagine if we deployed half of our fund in the first 12 months, we would be concentrated in some of the most overvalued, early stage assets of our time. And thankfully we didn't, and where we still have, the far majority of our funds will have been deployed in what I call normal prices, thankfully, because we've been sticking to that time horizon.
Yeah. Yeah, that's a great strategy all in all. And now let's talk about a deal breaker for you. Let's say everything looks great, like the numbers are great, the trajectory is upwards. But what's something that, despite all those things, you'd still not invest?
Sure. It's a good question. I think motivations of the founder is very important. One thing that we've learned is there's so many great businesses out there, but it doesn't mean it's a good investment for us. Our style is the VC, the type of VC we try to be in our firm and our investment strategy. And so for us, one thing we don't compromise on is, why are the founders doing this? If we find a company can have the best metrics in the world, to your point, but if we find the founder, motivation for starting the company is sell it within 3 years, that's a complete deal breaker. And we have never and will never invest in a seed company where, there's a short-term exit horizon. The reason why is because we are in it for those very large outcomes, right? Now that doesn't mean, if, let's say, within 3 years, if someone offers the company, a $2 billion outcome, sure, but that doesn't happen within 3 years, right? So, for the returns that we typically look for in our early stage investments, that's a big deal breaker for us. There's other deal breakers too, but that's the biggest one probably.
Understood. Understood. Yeah. All right. And let's talk about changes in the industry. So, if there is one change that you would wish to see in the venture capital industry or the startup ecosystem, what's that?
I love this question. It's actually what we're trying to do. A big mission and purpose of why we're doing this. So many people ask me, why are you a VC, right? And they ask my co-founder the same question. You were a founder, you were an operator. Why don't you just keep doing that? Because what we're seeing in the market, if we take a step back, it's a great time to be building a company. It's actually the best time to be an entrepreneur because of the amount of funding on average and relative to prior periods that has been allocated towards the early stage innovation economy. And why has that happened? Well, because people realized, especially over the last, 5 years or so, that the world's largest problems will inarguably be solved with some level of technology. So, well, wow, okay, that's the innovation economy. Now, there's the beauty and the beast. The beauty is we have all this capital now allocated towards early stage, but now the beast is we have not, as an industry, made sure that we have enough institutional support know-how to responsibly and effectively deploy this capital and partner with founders. That's where we come in. And many of the things we talked about here are how we elevate the standards of the VC industry. At the early stage in particular, there's some firms doing a great job of this, to be clear. We're not the only ones doing this. But this is why we're building 186. We want to elevate the standards on how VCs should partner with founders. It's no longer, 10 years ago, even not even 20 years ago, even 10 years ago, there weren't that many VCs. So I felt like, I feel like the industry was able to get away with a certain level of standard on how they partner with founders. But now the tables have turned. Even though we're in a downturn, fine, valuation and terms may have changed, But in terms of what founders should expect from their VC partner, that has not changed. And I think that as an industry, inevitably, I think things will elevate because you just won't last and compete if you don't. But that's what we hope to see. We hope to see change in terms of the seriousness and intensity at which VCs partner with founders. They're laying their lives on the line to an extent, you should too, in the sense of at least how you care and think about what they're building. So that's, I would say that probably.
Yeah, absolutely love that answer. And now, uh, like, is there a contrarian investment that you've made that you'd like to talk about? Something that most people, most VCs would probably pass on, but you thought, okay, let's take a bet.
Yeah. There's a few examples there, quite a few. I'll, use um there's two in particular, but we'll use one from about a little over a year ago. We've made only one emerging market investment in our portfolio. It's in a company called Moni Africa. And it was contrarian for multiple reasons. One, we're a US based fund investing in a company based in Lagos, Nigeria. We've never built, we have experience in building and investing fintech, but we've never built an emerging market fintech. And then also too, there are quite a few of micro lending businesses and banking companies that have come to the market. So why did we do it? Well, I think a combination of the founders, Femi and Dapo, when we met them, I mean, they were so um, uniquely equipped, given their former fintech and World Bank experience, to really fix merchant lending and merchant banking in Western Africa. But then also, what we spend a lot of time on is what hasn't worked. And in the past, if you really think about it, the reason why lending in Africa in part hasn't worked, outside of there being not enough debt facility actually available to small and medium sized businesses, but just as important of a factor is the risk model just has never worked. And what we found was that this company was able to maintain at a profitable measure, high enough margins, low enough default rates on all of their loans. And they were able to do it by the term length. So they only do 7-day loans. People may think, well, what can people do with a 7-day loan? That doesn't make sense. It actually does. If you talk to merchants on the ground, which we did speak to some merchants, you find that 7 days of capital can do a lot for a small to medium sized business in Western Africa. And so there's other reasons too, but we invested. They were doing about 40,000 in monthly gross revenue with fairly high margins, and about a year later, they were at about 500,000 in monthly gross revenue. So that one was a contrarian bet, and so far it seems to be playing out in our favor. Hopefully, we anticipate that'll continue, but it's still early, so you never know.
Yeah, absolutely. That's great. And now let's move on to my last main question before we move on to the rapid fire round. And this one is about what's your biggest learning investing in startups over the years? Or maybe something you wish you had learned earlier in this journey that you've learned now?
Yeah, I would say spend a lot of time with two things. I would say one, learning um, is kind of always take a first principles approach to why a company is building something. Put yourself in the shoes of the customer, and just do that immediately. Don't pattern match, at least in early stage, right? Don't, oh, what's the business model? How big's the market? Those things matter, of course, and they should guide you viscerally and subconsciously. But a lot of the upfront should be just spent on putting yourself as much as you can in the shoes of the customer and the founder, because it really is eye opening, and it enables you as an investor to identify pretty quickly on whether you should spend more time with them or not. Because that's the biggest thing. Learning, I guess now we'll segue into a second learning, is identifying as quickly as possible which companies to spend time on is actually one of the most important things. Because for us, at least, we get over 1,000 deals sent to us organically every year, right? Well over. And then it becomes, well, what do you spend time on? Because you only have so much time in a day. So identifying very quickly if you should spend more time on that company is important, and there's different ways to be able to do that. And then, what I brought up earlier too, don't compromise on founder motivations. Just don't. It's just not worth it. You're partnering with that team for 5, 10, maybe even more years. So, don't compromise on things that are very important to you.
Absolutely. Those are like great learnings right there. And now let's do the rapid fire round wherein I'll ask you 5 quick questions about the fund and you
Sure.
have to give 5 quick answers. Sounds good.
All right, let's do it.
All right. So the first one goes, what are the sectors and regions you invest in?
Yeah, sectors include software, pre-seed, and seed, and will embedded financial infrastructure, developer tooling, um, AI-enabled automation at the application layer, enterprise SaaS, property tech, and some consumer.
What's the typical stage of investment?
Pre-seed, seed. I mean, it really varies. It could be anywhere from a napkin idea with barely any incorporation documents all the way to $1.5 million in revenue.
Great. And what's the typical check size you put in?
$250,000 to $1.5 million.
Right. And what's the way where founders can reach you or pitch you in case there's a direct way?
So my Twitter DMs are open. So feel free to follow me there at gstuto, GSTUTO. We also, do have an open email address, hello@186ventures.com, that you can shoot an email to as well.
All right. I'll make sure to put all those links in the show notes below. Thanks so much for coming on, Giuseppe. It was a pleasure hosting you and happy investing.
Thank you so much, Prashant. Appreciate it. Enjoyed my time here.
Thank you.